Good morning. For this 10 minutes call, I want to speak about ways to be able to reduce taxable assets using your current exemption to move assets during the client's lifetime. Also, be able to create liquidity outside the estate. So, be able to consider options like life insurance, but explore other options, that come up first, maybe such as charitable remainder trust. But what we're finding is that in the middle market clients often have significant wealth, but lack the flexibility in removing it from their estates. They require strategies that provide liquidity to preserve both control during their lifetime and their legacy afterwards. These are some of the techniques that we're going to speak to this morning on this 10-minute call. And afterwards, if you'd like to, going to be sharing a slide deck with you. And afterwards, if you'd like to have a copy of this slide deck, just email me and let me know. I'm jim@camisadvice.com, and I will certainly send you a copy of this. So what I'm talking about today is estate taxes, estate tax and sunset. So my name is Jim Carpenter, and I'm with Camus Advice and Advisory Relations. And some of the things we're going to speak of real quickly is what is estate taxes? Will this apply to you? Estate taxes and how to plan. Traditional trust solutions such as eyelids and slats. So what are estate taxes? Very few taxpayers realize that we have multiple taxing systems: income tax, capital gains tax, gift tax, and estate tax, to name a few. But today we're going to focus on estate tax because our industry, financial services and life insurance services, anticipate a considerable change in estate taxes in 2026, and we want you to at least understand what it is. So this is the lifetime exemption, or another name for it is the estate and gift tax exemption. This is an amount that, as a taxpayer, you are able to gift during your lifetime or transfer after death, and the IRS does not subject the amount to gift or estate taxes. However, once this exemption is used, the remaining amount of assets is subject to estate tax, and that is what we're talking about today. What's interesting about this graph is today, the lifetime exemption is, in 2004, it is $13.6 million. This is the amount you would give away today, and only remainder of your assets are subject to estate taxes. Now, if you are married, you and your spouse can give that together. So you would need an estate in excess of $27 million to worry about estate taxes. So now we fast forward to 2026. It's gonna come quick. That exemption amounts drops to what we expect will be around $6.5 million. The picture is a little different. Now, a joint estate for a married couple will be subject to taxes after about $13 million in 2026. So why is the lifetime exemption changing? So back in 2017, the Tax Cuts and Job Act implemented sweeping changes to the tax system. Whenever a tax bill is proposed, it has impact on the national budget. When provisions sunset, they simply expire and the previous law replaces it. For the exemption, the previous base amount was $5 million and tied to inflation. This is why we see such a dramatic drop in the exemption and why so many more people will be subject to estate tax. So estate taxes may not have been an issue for you before sunset. 2026 is the end of high lifetime exemptions. Estate taxes will impact those with fewer assets, and the estate tax reduction may not work for you if you need or want to retain control of over your current assets. So, in the big picture scheme of things, there are three ways to plan for estate taxes. One is reduce that which is subject to estate tax. This typically involves gifting assets during your lifetime, using the lifetime exemption to make certain you are not causing gift tax through these transfers or transferring assets to irrevocable trust, which carves out assets from the estate for the benefit of beneficiaries you named prior to signing a trust. The second method is to find liquidity. Estate taxes are due in 9 months from the date of death and are paid for in cash. This means the family either needs to sell assets like real estate or investments, or the family can take advantage of liquidity created by the death benefit. This normally is not a preferred method. And have you ever heard the term fire sale? Be careful that the death benefit is also not included in the estate for tax calculation. How? By placing insurance in an irrevocable trust, which we will see in a little bit. Or if your estate is big enough, you may consider a combination of both, reducing estate taxes and creating liquidity. That's the we prefer to do. So traditional method to provide liquidity. There is a whole world of different types of trusts and different provisions and purposes. For today's discussion, we're going to focus on two basic types of irrevocable trusts that are traditionally used for addressing federal estate taxes. We will discuss the irrevocable life insurance trust, or ILIT, and the spousal limited trust, or SLAT. So let's start with the ILIT. To remember, it is only those assets that you own and control that are included in your gross estate for purposes of calculating the estate tax. If assets are outside your estate and you do not control those assets, then this is kept out of the formula for calculating estate tax. So remember, you're only taxed on what you own, not on what you control. It's been said that many times some of the best estate planning that you can do is the day before you die is to own nothing and control everything. So this is why we like life insurance and irrevocable trusts. The purpose of estate tax planning. The trustee applies for and purchases life insurance, which is held by the irrevocable trust. Typically, the insured is the grantor or grantors of the trust. In other words, you dictate the provisions of the trust, sign it into existence, and then the trustee takes over to maintain the life insurance policy. The trust will provide lifetime gifts to your beneficiaries in form of rights to distributions, and then, when the time comes, the life insurance is paid into the trust outside of your estate. The trust continues for the benefit of the beneficiaries. So first, the grantor establishes the trust and makes a gift each year to the trust. This gift is used by the trustee to purchase life insurance, hopefully from Ben Mutual, who prepared this PowerPoint presentation. When the insured passes away, the death benefit is paid into the trust, and the trustee can work with the grantor's estate to provide liquidity by borrowing funds or swapping tangible assets like real estate for cash. The purpose of this type of planning is to keep the death benefit out of the grantor's estate and providing a source of liquidity at death to pay any expenses or taxes that are due. This also allows the trustee to hold excess proceeds for the benefit of the grantor's family if they have passed away. Then we also have the spousal limited trust, also known as SLAP provisions. So let's say an ILIT has some appeal for your estate, but you are concerned with giving up control of the assets in the trust. Remember, in an ILIT, you are unable to reach the living benefits of the life insurance policy. A spousal limited access trust, however, does lend a bit more flexibility. The way this structure works allows one of the spouses to be a beneficiary of the trust. Therefore, one spouse acts as a grantor and establishes the trust, naming the other spouse and their children as beneficiaries. In this scenario, the non-grantor spouse can request funds from the trustee to support his or her financial needs. The grantor spouse, however, cannot access any control over the assets. This is what helps us keep the death benefit out of the estate. So as you can see from this flow chart, it's very much like an ILIT, but the difference is your spouses play different roles. One is grantor and one is beneficiary. A word of caution: in the event of a divorce, this trust is considered an asset of the beneficiary spouse. It will not be included in the division of property. So planning rules are changing. So what can you do to protect yourself? One, consider whether your family will need to deal with estate taxes at your death. If so, consider what techniques would be willing to implement to address that need. And as we covered life insurance trust, perhaps this would work for you, or perhaps there is another technique that is better suited for you. So meet with your attorney, financial professional, or CPA to have this discussion. So that's a slide deck that we have been able to utilize, and it could be helpful for you in your business. So went a little bit over time. I hope it's all good. Have an amazing week. Thank you. Thank you very much.